So guys, welcome tonight. I hope you get some enjoyment out of tonight. My name's Allan Shenouda and I'm the Managing Director of Bespoke Financial Advisory, and I'd like to welcome everyone here tonight. So I'd like to also express our gratitude for the NAB team and Ray from FX Treasury for giving us a bit of an insight on probably the pressing news in the current environment at the moment, so what's concerning us. So furthermore, I hope you get some value out of tonight, so please, it's an open forum, ask whatever questions you like. Okay, over to you, Ray. Thank you.
Good evening, everyone. Thanks for the opportunity to come and have a bit of a chat. As Alan says, I work within the markets division of NAB, so on the trading floor at the NAB swanky offices at 2 Carrington Street, and I'm part of what's called the Global Markets Research Team, which effectively consists of about a dozen people either in Sydney or in Melbourne, and we're really covering both the macro economy, but also the interest rate side of the business, but also foreign exchange. So my speciality happens to be foreign exchange, which might be I'm a little bit more passionate about whether the Aussie dollar is going up or down than you might be, but you may be more interested perhaps in the interest rate side of things. But the fact is that there's a lot going on in the world that kind of impacts on currencies as much as it impacts on interest rates. So I think the idea was to try and share with you about sort of thinking about the state of the global economy. There is no good news, by the way. I don't have any happy stories to tell you, but because interest rates are going up and currencies are going up or they're not going down. But the world's not in a happy place at the moment. So just to give you a little bit of a run through. I'm more than happy just to sort of use 5 questions as we go along. So I'll probably whittle on for half an hour or even longer unless you drag me off. So do please stop me and ask questions as you go. So I guess the starting point really is to say, why is the world not a particularly happy place? Well, typically, if we're going to have a global recession, and there's a pretty high chance that we are, historically, recessions in the world are usually caused by one of 3 things. They're either caused by an oil price shock, or they're caused by wars, or they're caused by policymakers jacking up interest rates too much. Okay. So currently we've got a war, we've got an oil price shock, we've got central banks around the world who are starting to jack interest rates up, and we've got a Chinese economy which is in pretty dire straits at the moment. Okay. So rather than the normal 3 things, that any one of which can cause a recession, we've currently got 4. So the probability of the global economy escaping quite a significant economic downturn is actually quite small at the moment. So I'll maybe flick through those a little bit, but if you go back to that first chart, but maybe start with the Eurozone. So, I kind of think of the world really as, much as I like to think Australia is the centre of the universe, economically speaking, there are really 3 big sections of the world. There's the US, there's Europe, and there's China, basically. And at the moment, Europe is in a world of pain and China is in a world of pain, and the big unanswered question at the moment is whether the US is going to effectively fall into recession, either because of what the Federal Reserve is doing with interest rates, or because the rest of the world is in such a bad state that actually it's got the potential to actually drag the US economy down. Okay. So if you look at the Eurozone, the real issue, of course, is the war in Ukraine, and it's really impacting on the European economy and the Eurozone economy in particular, really through 2 big channels. First and foremost has been the energy price shock that we've seen. So we've seen a huge uplift both in oil prices and particularly gas prices. So Europe is not totally, but heavily reliant, something like 50% of all the gas that the Eurozone consumes comes from Russia, and about 30% of oil comes from Russia. And obviously the current debate is about whether or not European countries are going to agree to impose an embargo that effectively says that as of the end of this year, we're no longer going to be buying any oil from Russia. And assuming that goes ahead, I think it's quite likely. Europe knows it's going to have to inflict quite a lot of harm on itself, basically, for what it considers to be the greater good, which is to hurt Russia economically as much as it can, in the hope that it will effectively, bring about an eventual end to hostilities, because the financial pipeline, if you like, that Russia depends on in order to finance the war is going to be cut off. The risk is that doing that will inevitably hurt Europe because of its dependence on oil, but Russia may well retaliate to that by actually cutting off the supply of gas into Europe. So economically and financially, Russia gets much more of its revenue from selling oil to the rest of the world than it does selling gas. But Europe is actually more dependent on gas coming from Russia than it is from oil. So one of the ways that Vladimir Putin might decide to retaliate against any EU-imposed embargo on oil is to say, okay, if you're not going to buy our oil, I'm turning off the pipelines of gas, effectively, and that will impose an enormous amount of the Eurozone, to the point probably where not only will we see further pressure on prices, but potentially we will also see supply internationally. If Europe can't physically replace oil, particularly gas, that's from Russia, for over anything other than, say, 3 to 5 years in the short term, it's simply won't happen. And in economic terms, what we're seeing is that a part of the world that used to run big trade surpluses so will export more to the rest of the world than they buy from the rest of the world. That's all flipping around because of the cost of energy imports. It's flipping part of the world that's traditionally running surpluses into part of the world that's running deficits. So that's hurting them directly. It's impacting on the value of the euro exchange rate in particular, which has been approaching parity against the US dollar. And it's impacting on economic activity and sentiment, which is seriously impacting things like business and investment. So the Eurozone economy is still growing at the moment, and at the moment we're into the Northern Hemisphere summer. So at the moment Europe is less dependent on oil and gas imports from Europe because usage is actually very low. And you come into the Northern Hemisphere winter, so come kind of December, January, February next year, that's when the rubber will really hit the road in terms of if there are shortages of oil and gas at a time when demand is worse, then that's when you're going to see the worst of the economic hit. So in our forecasts, we're saying that the worst of the European and the Eurozone economy is still in front of us. But potentially that means that the euro exchange rate is coming down, pressure to come. So Europe doesn't look great, and if it is the case that Europe cuts off completely its dependence on oil and Russia retaliates with some reductions for gas, then all of the modelling is being done by central banks in Germany, for example, saying that we're going to turn an economy that's barely growing into one that's going to be outright contracting. Okay? So depending on what happens with oil and gas in the next 6 months, there's a very good chance that Europe will be in recession. And then if we look at China, China's problem is what they call a zero-COVID policy. Okay? So unlike every other part of the world, China has determined that it needs to eliminate both the Omicron variant. No country in the world has come to the conclusion that is really bad. President Xi, who was determined to be re-elected president for life from October, November, has determined that this is the winning policy. Drawing comparisons between, for example, the death rates in China compared to the United States and other parts of the world, that actually China has handled COVID far more successfully than most other parts of the world, and that therefore this is a winning policy. But the reality is that China's vaccines against COVID, particularly against the Omicron variant, have very low efficacy rates. And plus, although they have a high total share of the population that's been vaccinated, the share of those, we say over 50, let alone over 80, who've had 2 or 3 vaccinations is incredibly low. So the reality is that China knows we'll let everybody in Shanghai and Beijing come to play. They're going to be faced with an infection wave that's going to overwhelm that system. So they're faced with this problem that if they lock everybody up, which is what they've been doing in Shanghai, the economy has been crucified because people just simply can't get to work and they can't pay some money. And if they release the pressure valve and let everybody out, that they're going to have a fresh Omicron wave in their hands, and then the health system's going to be overwhelmed and they're going to make it again. So unless or until China actually develops and releases an mRNA vaccine that is at least as efficacious as the ones that most of us are familiar with, there really is no solution. It probably means that we're going to have these rolling lockdowns in China for many months to come. This place we're getting here is just like Google mobility stats, basically telling you the mobility in terms of people moving around Shanghai is currently 0, for example. And we see a lot of other regions that sort of follow that down. And that really gets hand in hand with the rise in COVID cases that we've seen. How that's showing up in the economic numbers is in China. One of the statistics that we like to look at globally to give us a real-time gauge of the health of any economy, what we call purchasing managers services surveys. So it's really surveys of businesses around the world saying, has your economic activity gone up, down the last month? Are you hiring people? Are you firing people? Are you raising prices? Whatever. How long is it taking you to receive deliveries from your suppliers? All of these things go into what's called a purchasing managers index, and they're all released at the same dates around the world simultaneously to give us a really good snapshot of the health of the economy at the time. And this is China as of last week. What we see is this is what happened during the early stages of the pandemic. So whether it's manufacturing or non-manufacturing services, effectively and then unlike the current situation, within a few months effectively, they're on top of the wave and they managed to react to the economies and we saw this huge bounce back. So the bounce back was almost as severe as the downturn that we saw. The current situation is very, very different in the sense that China isn't going to suddenly say, hey, everybody can go. Even if they reduce the restrictions, people are going to be very, very hesitant. People are really scared, they're caught in propaganda that Omicron is a really, really serious disease. You see that certainly in where I live, which is more of a Chinese area north of Sydney. You find everybody's wearing a mask. They're still very, very concerned that they haven't had COVID, they're going to get it, it's going to do serious harm to them. So even if the formal restrictions are released, you're probably going to see an enormous amount of hesitancy in terms of economic activity to come. But already you're seeing that these indicators, whether this is actually services activities, and this shows that you can't go out, you can't go to a restaurant, you can't go shopping, etc. But the manufacturing sector is also suffering because even if the factories are open, staff can't go to the factories, for example. Even if the factories are making goods, they can't ship them to the ports because transportation is shut down, for example. So there's a bit of a perfect storm going on at the moment. And being that China's economy is probably going to be in a world of pain for, our best guess is certainly until very late this year, so the very earliest we're saying, wow, 6 months. We might expect to see China in a better position than it is today. So the Eurozone's not looking good, China's not looking good, so that's 2/3 of the world ticked off, if you like. Again, just to show how to show up in the numbers, we're always used to seeing China's economic growth is 6 or 7 or 8%. They've got a target for growth this year of 5.5%. It's completely unrealistic at the moment. They probably will deliver it, they will deliver what they say they're going to deliver. But if I look at something like industrial production in China, is actually fallen by almost 3% in the last 12 months, which is unprecedented. If I look at the amount of retail trade that's taking place, it's basically unchanged from where it was a year ago. So it's really showing through in the hard numbers. And what China says it's going to do is, don't worry, we're going to offset that. We're going to do old school infrastructure spending, we're going to put houses and we're going to do roads. For the property sector, we're going to be completely well paid because of the collapse of all these property developers. So virtually no amount of government spending and stimulus is going to be big enough to actually offset the drags that come from industrial production. So in all faults, there's a lot of businesses that are all going out. And the real significance of the China slowdown is that what happens in China happens to the rest of the world pretty much. So thinking about those purchasing manager surveys, this is China, and this is Germany, and this is the rest of Europe, and the purple one is the US. Essentially, when China's purchasing manager surveys turn down, 2 to 3 months later, it happens in America, it happens in Europe. So the rest of the world is very, very dependent on the strength of China's demand. So as China is weakening, we're starting to see signs of that coming through. The Eurozone numbers are already weak because of the war. The US numbers look like they're starting to turn down now, which would be totally consistent with China turning down 3 months later, the US turns down. So the risks that the US is going to suffer by a significant downturn that might not be evident in the first 6 months, but the risk of that is certainly rising. And then the other thing that is worth noticing is that China is a very credit-driven economy. The world, the Chinese economy revolves around the availability and the price of credit. But the rest of the world seems to feed off China's credit impulse really pronounced. So basically, when the red line's going up here, the taps are open, Chinese credit is flowing, and they actually have a very strong relationship with manufacturing activity in the rest of the world. So you must think of it as, it's easy to go and get a loan in China, it's easy to go and buy a BMW from Germany, for example. And so it has a direct impact on the strength of the export demand of other developed countries, for example. And what we've seen in the last 6 to 12 months is that China's credit has been imploding. And lo and behold, it started to show up 6 months later, the signs that we can coming through. So significance of China shouldn't be underestimated. What does that mean down here? Well, being the currency guy, part of my job was to say, well, given the state of the world economy, is the world going up and down? That's why I can pay big bucks. Well, not so big bucks, but that's the same. And if you look at the global economy, so these red bars here is global economic growth. Okay, so the red bars are up the zero line, global economy growing, red bars below zero, global economy is contracting. And this goes back effectively 40 to 50 years. Okay? What it tells you is that every time the global economy goes into recession, goes into a period of slow growth, the Australian dollar always falls. Done that invariably in the last since 1993, it's the strongest currency. So if we're looking at a scenario, so this is obviously the impact of, it only goes up to 2020, so you can actually see the impact of the pandemic, but not subsequently. But so every time that happens, the currencies come down. So given a fairly pessimistic view of how the global economy is going to be looking at this 6 to 9 months, it's pretty hard for us to have a positive view about what that means for the Australian dollar in particular. Where past may not be a good guide to the future is that if I think about the same picture in terms of global economy and I look at commodity prices, the main thing that, as a currency specialist, and people say, hey, how do you forecast the Australian dollar? The answer is I go like this, but I try and have a few tools, if you like, that historically have been very good for guiding the performance of the currency. And the 3 things that I always pick on are what's happening with commodity prices, because we are a country that has a very big commodity export sector, and the price that we get for those commodities has a big impact on the wealth that is coming into Australia, and it has a direct impact historically on the value of the Australian dollar. What's happening with interest rates here compared to the rest of the world is important, but actually less important than we think it might be. And then the other thing that's really important is what's called risk sentiment. So whenever you turn on the news and find that the Aussie dollar's falling below 70, I guarantee you that the item before that, the news, or the item after it, is that the US stock market fell by 3 or 4%. Okay? So last night the Aussie dollar was 69.50, and the S&P 500 fell 4%, and the Nasdaq fell 5%. So every time the world becomes an unhappy place and investors retreat and move out of risky assets, one of those assets they tend to move out of is the Australian dollar. We're a country that still owes $1 trillion to the rest of the world. I'm sure we're tired of hearing 2 days before the election that we've got $1 trillion worth of debt pipe on. Way that much money is going to disappear in a couple of years. But the fact is we owe so much money to the rest of the world, and we rely on the rest of the world continuing to refinance that debt over time. And if the world's an unhappy place and people are scared, they want money to sit on the mattress. Money to come in. So all of those things matter. But historically, commodity prices have been the thing that matter more than anything else. To go back to this argument about this health of the world economy, every time the global economy turns down, commodity prices, which is this black line here, they also go down, okay, which makes sense. If the world is not spinning as fast on its axis, the world needs less oil, the world needs less industrial metals, whatever it is, basically. So commodity prices typically move in the same kind of trajectory as the performance of the global economy. Okay? The issue out now is that commodity prices are up here. So I might be very pessimistic about the global economy, but commodity prices, as they affect Australia, have never ever been as high collectively. That's just what you call the the terms of trade. Okay? So my forecasting accuracy with currency has been pretty lamentable in the last couple of years because the models have all been telling us, well, commodity prices are going from here to here. The last 50 years tells you the Aussie dollar should go from here to here, and the Aussie dollar's been going down. So it's been a real challenge to accurately find what's going on. So if I tell you, every time the global economy goes to proverbial, the Aussie dollar goes down, part of the reason for that is every time the global economy is in the doodah, commodity prices go down. So what if the global economy goes into recession and commodity prices stay high? Is the Aussie dollar going to go up or down? Discuss. So that's what I spend most of my time thinking about. It's, which will sort of come on to a little bit more. Come back to currency as we can, which is my favourite subject. But I'm sure you're all kind of interested in what's happening with interest rates. So there's a lot of movement in interest rates globally, and obviously here, there's an Australian bank's first move for over a decade on interest rates a couple of weeks ago, and they pretty much promised that there is more where that came from. The question is, well, how fast, and where are you going to stop? I'm not sure I have the exact answers to that, but that's very much a global question. And what's changed in the way that central banks are thinking about the world is that it used to be, well, inflation's been hard in life, but the economy is not in great shape, so we've got to be really careful about raising interest rates because we don't want to tip the economy into recession. That's last year's narrative. The current issue is inflation. Is just so high here to some extent, but much more so in the rest of the world. So last night, UK, for example, printed a 9% inflation rate, the highest inflation rate they've had in. As long as I can remember, I probably remember for that with most of you. Okay, so 9% inflation. A lot of that is to do with energy prices. So they've had a 54% rise in household utility bills in the last couple of weeks, for example, with all the turmoil and gas increase. But the UK's got inflation of 9%. The United States has got an inflation rate of 8.2%. New Zealand has got an inflation rate of 7%. So these are all central banks that are all charged with keeping inflation at 2%. So, you know, inflation goes up, inflation goes down, but when you're targeting 2% and the actual rate is 9%, you have absolutely no choice but to try and stay there, regardless of the consequences. And that's the environment that is suddenly finding itself in now. So you can sit there and say, well, if the Fed raises interest rates by another 200 basis points, and the RBA takes the cash rate up to 1%, the economy is going to fall into recession. Central banks will say, well, if that's what it takes to get inflation back under control, then that's what we're going to do. So it's a pretty scary environment, and it means that we're very much at the beginning rather than the end of this process of interest rates going up. And the reason that central bankers are all running scared at the moment is that they've taught themselves over the last 20 or 30 years, and they've done all the academic studies, and says the most important determinant of what inflation will be at some point in the future is what we think it will be. So if you think inflation is going to be 5% in 5 years' time, a lot of your behaviours are going to be conditioned by that. A lot of the demands that you might make of your employers to say, well, I think inflation is 5%, I need a 5% pay rise to compensate you for that. Good luck getting that, particularly for a banker, I have to say. But the fact is that central banks think that if inflation expectations get out of control, they won't be able to put the genie back in the bottle because they'll be creating this kind of self-reinforcing spiral where prices go up, consumers think they're going to keep going up, consumers are going to make more demands of employees for wages, and as we know today, the unemployment rate being printed at 3.9%, which is the lowest level it's been since 1974. The US has got an unemployment rate below 4%. So the UK has got the lowest unemployment rate since the generation. So actually, employees are in a pretty strong position. The last day review, but showed lots down the road, just offered $2 an hour. So if you want to stay, you're going to have to match it. Okay? And that's the real fear that you get into that wage price fight. At the moment, companies feel able to pass on the costs, but they're actually paying a lot of the wage amount, but they're still falling short of the actual level of inflation. But all that got to say is we've got inflation expectations, this is for the United States, gone from being below 2% prior to the pandemic, which is below where the US would like inflation, to being up closer to 3%. And this is what's freaking out the central banks at the moment. So we've really got a chance to get this inflation genie, if you like, out of the bottle. And we're going to do whatever it takes to do that. If that means causing a recession, then so be it. You sit there on the other side of the argument and say, well, why is inflation so high? Well, inflation is so high because of COVID, because of all the supply chain disruptions that are still ongoing in China, for example. So there's simply been a massive reduction in the supply of goods in particular. At a time when during COVID, people couldn't go out to play, they couldn't go to restaurants, so they bought more stuff. Like whether it's equipping their home office, or upgrading the car, or the husband who's been at home is being told for the last 5 years that his house needs redecorating, and finally decided that maybe a point after all. So people are spending on home improvements, etc. So the demand for stuff basically went up at the same time the supply of stuff went down. So lo and behold, the price of goods went up. So even if those supply chains are the underlying cause, it still means that demand is bigger than supply. And economics 101 says, what's the definition of inflation? It's too much money chasing too few goods. So households have to be cashed up by the government spending that's been involved in a way. The supply of stuff has been reduced. Inflation has gone up. You can say, well, that's all very temporary. The central banks were saying that 2 years ago, they were saying that 6 months ago, now they can say it's 6 years. The fact that it's showing up in inflation expectations, that means I don't think inflation is so it's forcing them to sound incredibly hawkish. So fair to say that we raised rates half a point last month. We're going to raise another half a point in June, and we're going to raise another half a point in July, and then we're going to decide whether we can slow down or increase. But what central banks want to do is they want to get rates that will become neutral. So at the moment, our interest rates went up, but it's still miles below what we would consider to be a normal interest rate for something. So the big debate is how high do you have to get interest rates before demand in the economy starts to cool, because your mortgage payments are absorbing a sufficiently higher share of your income, and that is going to mean you're going to have less money to spend elsewhere, and hopefully that in Australia is not divorced from that. So they look at inflation expectations. In Australia, they've gone from around 2% prior to the pandemic, and the Reserve Bank of Australia has been trying to get inflation at 2.5% unsuccessfully for most of the last 7 or 8 years. All of a sudden, inflation is sitting at whatever it was 5.1%. So a couple of weeks ago, inflation expectations are starting to rise. So the Reserve Bank governor, who told us 6 months ago that there was no way on earth that rates are going up until 2024, we all said, liar, handsome. It's now at 6.5, and yet the forecast is still an interval, and now it is thinking that less interest rates. Actually, just skip to the next chart. I won't go through this in detail, but I came across this yesterday. This is a survey in the US that was published last week. It's a huge institute that asks Americans, what is the biggest problem facing the country today? Now, COVID, number 10. Inflation, number 1. So Americans think that high inflation is the biggest single problem today. And that is why the Fed is doing what it's doing, and it's why the American government, who usually sit there and scream blue murder at the central bank and say, how dare you raise interest rates and make people worse off, and say, you're going to get on with the job, James, because if you don't get inflation under control, we, the government, are going to get blamed for it. We are going to get turned out of office, and the midterm elections take place in November. If things stand, the chances of the Democrats to take so getting inflation back under control in the next 9 months is absolutely crucial from the government's point of view as well as the central bank's credibility. So this is effectively spurring on the elections. As far as the RBA is concerned, this is what the market thinks the RBA is going to do over over the next sort of 2 years, basically. It says it's going to get rates up to about 2.5%. So where are we now? We're at 0.35. I'm sure you'll get help me out with these. You get stick 4 weeks ago for being asked what the cash rate was and not having a clue. There's a lot of pointing headed economists who now can't get clear about the fact that the cash rate is 0.35. It's going to go up to 0.25 at times. What's it going to be next month? 0.35 plus 0.25 something. So maybe that will change and we'll go back to round numbers at some point. But what the market thinks is that, let's rephrase that. This is where the market thought 2 months ago the RBA was going to lift rate, thought rates were going to go up to about 2.5%. As of Monday, the market thinks that rates are going to go up 3%. So in terms of thinking about, interest rate risk management, the markets are not only 2.5%, which is where we think might be the neutral rate, where monetary policy is not stimulatory and it's not contractionary. They're saying we think you're going to have to take rates into outbound restricted territory in order to get inflation back to 2.5%. So we see a huge, not only a repricing, but also a bringing forward the speed with which rates can go up. So central banks again said, will we raise rates? It's going to be a very gradual affair. They've changed all that, saying monetary policy is way too easy, inflation is running high, we need to get rates where we are now to something that we consider to be neutral in really, really short order between now and the end of the year, which is why the US Fed is now getting rates up to 50 basis points to clear. The Canadians are doing that, the New Zealanders are doing that, for example. Governor Lowe tells you, 25 is okay, but if inflation goes from 5% to 6% in the second half of this year, there's a very good chance that instead of 25, we'll see 40. So I think you have to be prepared for a lot of front-loading, like the interest rate side. So our own view is down here. So we're actually at odds with the market. We actually don't think that the RBA will be able to keep rates up here. And the reason for that, on the upside, is the amount of mortgage stress that we can't with rising interest rates. When we were down at 0.1%, only a couple of months ago, the average mortgage owner in Australia was spending 4.4% of their income servicing their mortgage. So some people have no mortgage, some people are spending a hell of a lot more than 4%. If you go back to the average over the last sort of, since 2008, since the PFC, on average we're spending about 7%. The cash rate goes up to 3.25%, which is what the market's in pricing. That means people will be spending close to 10%. And we're really starting to see the housing market, certainly in Melbourne and Sydney, starting to turn down. Melbourne looks like it's gone flat, Sydney looks like it's going to fall. If you look at New Zealand, house prices are falling at a double-digit rate. So our sense is that the RBA won't be able to be as aggressive as the market is pricing, because they'll be too cautious of how quickly households will start to feel the stress of servicing mortgage rates. So that's why we're a little bit below the market. And the other big question that central banks don't know, because they don't know the answer, is what is a neutral rate of interest? What is a rate of interest that is neither stimulatory nor contractionary? And most of the models in Australia at least say it's around 3%. So the government's been talking back to 3%. But most of the historical modelling about what's a neutral rate suggests it's closer to 3. And that's probably the reason why the market's thinking that rates are probably the 3%. So they may well be right, but a lot depends on what happens with inflation. Just on mortgages, just out of interest really, but it's about 38% of all mortgages now in Australia are fixed rate. Okay? So that's up a lot. So go back just 2 years, it's around 20%. It's now closer to 40%. And something like 70% of all of the fixed rate loans that are outstanding are all going to mature before the end of the year. So people are locked in 2 to 3 year fixed rates and with a 1 or a very low 2 in front of them. They're the ones that are really making and that's where service that's attached to downward pressure on house prices and potentially dampening economic activity as people with their servicing costs. The weather is 10 to 6, so you probably have more than enough from me, but I'm going to leave you with a few comments about the currency if you can. Things to note about currencies, so many of you have, export or import type businesses, then of course you'll be as sensitive as I am to things in the exchange rate. And one of the things that's noticeable is that the last, if you go back 20 years, for example, this is the highs and the lows that we've seen in each quarter of the euro against the US dollar. So the last 12 months, the high's been about 78 cents, and the low's been about 68 cents. You can't keep spending. You can't buy the same amount of goods and services if your income's going backwards for the course of the year. And they're saying we're heading for a recession, and that is actually going to reduce demand sufficient to bring inflation under control. And that may be true. So why don't we need to raise interest rates? Because the hit to people's incomes is going to be enough to actually take care of inflation. And raising interest rates in the face of that is actually going to means that inflation will probably be too low. No other central bank is there.
There's probably two questions. The US dollar rising and continuing to rise to be the dominant volume in the world. Is that because countries buying US treasuries, the treasury bonds?
Yes.
Okay. The second
so they are in the sense that the US dollar is the world's equivalent reserve currency. Okay? So although central banks around the world hold some euros and hold yen, hold a little US dollar, hold a little Chinese yuan, the US dollar still maintains about 60% of all the reserves that the governments hold around the world. And the US Treasury bond is the most liquid, safe bond. It's not really get in, get out quickly without changing the price. No one believes that the US will ever default on its debts, even though it's actually got downgraded back in 2011. But it's still AA minus credit. So there you've got something creditors thinking getting out of the world, basically. You think the US dollar is ultimately reserve currency. So that's why the dollar works so well during periods of extreme market stress.
And the second question to that, I've been reading, I can't remember where, it's popped up when you were mentioning the US dollar being so strong. There's been an increase in countries manipulating their currencies, post-COVID pandemic. It's very open. Does that happen, and why do they do that? Is that to reduce their debt?
No, no country would tell you to manipulate. The biggest currency manipulator in the world is the US. Well, the US is the one that accuses other countries of manipulating the currency. If you really want to manipulate the currency, you need to change your interest rates relative to the rest of the world. And arguably, when the US dollar was really weak, which makes US interest rates higher than the world. Now, China does manage its currency. So if you've got a country that actually has what's called a closed capital account, so you can't freely take capital into China or bring capital out. It's very controlled in that sense. And the reason, one of the main reasons that these dollars are 75 cents or 70 cents in the last few months is that China has allowed currency to weaken. And the reason that they've done that is because Japanese yen. So think about Japan, think about China, they compete a lot in world markets, things like cars. So one of the consequences of US interest rates going up in the last 12 months is that the Japanese yen is the weakest currency in the world. Japan's interest rate is zero. For Japanese investors who could get 1% on lending money to the US 10 years a year ago, and now getting 3%. So they're saying, what's not to like about owning US treasury bonds? They're all investing overseas in US dollars. The Japanese yen is going down, and their manufacturing sector is becoming more and more competitive. So the China said they were rock solid currency had to move. So they said, hang on, our currency is only 10% against the Japanese yen. We compete with them in third markets for trucks, vans, cars. This is making it uncompetitive. So So they suddenly manipulate the currency weaker. The chart I actually wanted to show you, which was not this one, is just the relationship between the Australian dollar and effectively the dollar against the Chinese currency. Effectively, when the Chinese currency is weakened, the Aussie dollar historically is weakened. It's actually easy to show this. But this is the level of the Chinese currency against the US dollar. As you go out here, the Chinese currency is getting weaker against the US dollar. And this is the Aussie dollar against the US dollar. So moving out here, the Aussie dollar is getting stronger. And if you do fancy econometrics over the last 25 years, the relationship between the Chinese currency and the Aussie currency, you're going to say that most of the time, if you find out where the Chinese currency is, it tells you that the Aussie dollar should be somewhere in this band. At the moment, the Chinese currency is at 6.8 something, it's around here, and the Aussie dollar is around 7%. So it's doing exactly what it did. So as soon as China started allowing its currency to weaken, which I would argue is because they were responding to not wanting to suffer a competitive disadvantage against Japan, none of the Aussie dollar started falling. So there's a very strong, which goes back to that view that it's emerging markets, it's not as important as Australia. So we're at the moment, a lot of that forecast of the Aussie dollar, partly it's the US dollar story, but it's also how much more do you think China will allow us to weaken? Because the more it does, the more the Aussie dollar will weaken.
I'm just trying to understand, because generally when the Aussie dollar does go down, Australia traditionally is a dual economy. You've got your exports, which become, especially in the mineral segment, become much more, I guess, lossier than the rest. How does that help Australia? How would the impact in our economy? Because, for me, it's a little bit. You almost have two different countries in one.
Yeah, well, you could argue you've got two sides of the business. One, you've got exports, you've got imports. So, NAB Bank's more of them than any other bank in Australia. But probably for every exporter, we've got 10 imports, because the exporters might be, BHP or Rio, or Fortescue. But the importers might be people who run a local bicycle shop who actually import bicycles to China, for example. So far more importers who would like to see the Australian dollar as strong as possible, because it means they can buy, they're typically buying from China, paying for everything on the US dollars or Chinese currency. So you've got one group who like to see the US dollar go up, and you've got another group which might be coal miners, or they might be potters, or might be somebody else, who are exporters, who are earning US dollars typically, and the weaker the US dollar is, the more their dollar receipts from overseas are worth Australian dollars. So from the point of view of the competitiveness of the export economy, the weaker Aussie is good news. Where it's bad news is that it adds to the cost of imports. So it's bad for inflation. So at the moment, if the RBA worried inflation is too high, the Aussie dollar weakening is making the problem worse because it's adding to the cost of inflation. You go back 3 or 4 years, the early stage of the pandemic, and the RBA was cutting interest rates and doing all sorts of fancy things, printing money. They're very open about the fact that one of the motives for that was that they wanted the Australian dollar to be weaker. But that was a time when inflation was running below 2%, it's supposed to be 2.5%. So it's a kind of where the lead, whether it's going up and down, is going to add to and detract from inflation. And at the moment, you could argue that a stronger Australian dollar would suit because it would put a little bit of down. We actually had one of the senior officials of the RBA now in London branch last week, actually. One of my colleagues asked me and said, well, I'm worried about the Australian dollar being below 17. Things got water. No, it wasn't below 17, which is a worry in itself. Don't repeat that, please. It's nice rules. But the point that he made said, well, if the currency's too weak or weakens, we can just raise interest rates by more. Good. So from their point of view, they're saying, well, the currency is adding to upward pressure on inflation because it's adding to inflation. and inflation is too high, it might mean that we have to raise rates further or faster than we otherwise would, because we need to act there. So that's why it's a very sharp and it's a very two-edged sword.
Not asking for economic advice. Probably have a million advice. So there's a lot of doing in the next year to 2 years, possibly.
Let's say 3 to 6 months. Let's end on positive.
3 to 6 months. What does a typical person, you can say you have savings, you have a few properties, you've got a successful business. What do you do? Do you take risks? Is there opportunities? What can you see that others don't in a market like this? Because a lot of people get rich off this. Markets, I know that history.
I mean, I can't answer that question legally as well as I haven't got the answer. I think as a business, it really, at the moment, what we're finding is that the people that are getting rich are those that have price level. So depending on where you sit, segment, if you're a wine exporter, you take the price from the rest of the world, right? There's nothing you can do to influence. So it seems like if you're Jeff Bezos or you Microsoft or you're Tesla or whatever, you've got this demand-supply balance and you're able to pass on high costs, or maybe even, one of the issues during COVID is that, we had this massive supply chain disruption to the car industry. And, my old boss in New York was the car dealer phoned him up and we bought a car from 2 years ago and offered him 10% more than we bought the car from the dealer. Which is the short of the stuff. A lot of businesses, the margins But I think you've got to think that in a rising interest rate environment, certainly if you're long property, you've got to think that when I think we saw house prices, which was 20-25% nationally, was by and large was a function of affordability. If you reduce mortgage rates and stick 2 in front of the mortgage rate, previously you had 4 in front of it, you could borrow a lot more. And that is simply the reason that house prices went up. And all that Cassandra has said, even then was going to in the early stages to say the pandemic was going to cause collapse in house prices. 100% wrong. This was a fundamental misunderstanding of the fact that if you make mortgages 25% more affordable, people borrow 25% more to make some money to lend it to them, and lower what house prices go up. So if we're now in the reverse of that, and mortgage serviceability costs and affordability going up, plus of course the regulators have bigger buffers in terms of investing with a 3% buffer over the paying rate as a condition of lending. It's no surprise that house prices are supported. So I think we've got to respect them. I mean, our official view is that we see at least a 10% for house prices nationwide. So how you introduce that is not an area of expertise.
But isn't that rising inflation and even smaller rising interest rates are double whammy for a purchaser anyway? But they're still paying for half the disposable income's what? Well, if their basket of goods is 300, that's 380, that's $80 this and more.
Which means
you're not going to take it out of their necessities.
Yes.
But isn't that what the global world's going through? You've got high energy prices, high food prices. The basket of necessities is on 30% up. Services that pay the general household stuff.
So which actually
means that even that's why the British don't hang back, because they go, the households are
being crucified, right?
They're being crucified, so the time house prices will level off. You like.
Yeah, I think it's true. It actually means
so that's the other reason why we're in inflation. We're globalised more than ever in the last 100 years. So we can't call it.
Well, it's like
we could call it 20 years ago and done something. Now we call it and something else changed what we do.
Right, exactly. So it's the next way inflation here. The only areas that's like here. Blind Freddie can tell you, well, inflation's gone up to 8% in the US, it's about 10% in the UK, to 6% in New Zealand. Anything can
Making that more
But the point you're making is the right one, is that it's not just the mortgage stress and saying, well, the mortgage rate's gone from 2.5 to 3.5. the amount of disposable income that I have is going down. Real income is going down at the same time that servicing costs are going up. So I'm actually getting, which is your point, which is the double hit effect, which is another reason why we're probably sitting below where the market's pricing in terms of how quickly and where the RBA rolls will get to will be lower than the market's currently pricing. That's one of the reasons.
Yeah, thank you everyone for coming. Hopefully given a bit of context and a bit of substance to what's happening locally, what's happening sort of internationally as well. Thank you to all the partners at NAB and Ray for this evening. There are some about Jack and Catherine who work in the hedging part of the bank as well. So I'm sure if you guys want to hang back and ask a few questions, they'll definitely be available. And thank you for Ray for the